Hey, welcome to the podcast, everybody. Thank you for joining me. Hey, we're going to get into the markets here in just a minute. You can see the chart up on the screen. If you are new to the video podcast, welcome aboard. We go through just a little bit of everything. We go through interest rates, stocks, bonds. We kind of tell you maybe what sectors are working, which ones are not. And we try to do that as often as we can. And for those that are more technically savvy and want to see the picture, that's exactly what this video podcast is for, so you can actually see what I'm looking at. Don't forget our radio show every Saturday morning, 7 a.m. You can stream it live, or you can go to the archives after the fact, eggerscapital.com. And we're on Twitter. We're on all those places, Facebook, etc. And eggerscapital.com is the best place to get all the information. So let's hop right to it. Really, this market's been moving sideways. I think people have felt like there's been a little deterioration the last couple of months. And we know, regardless of whether the Fed raises rates in September or December or next year or whenever they do it, we're closer now than we were yesterday of them doing it. We're closer now than we were 2 weeks ago, a month ago, 6 months ago. And this time around, the market's digesting a little better. Remember, when we were in October last year, we had a kind of a little meltdown, and this was when QE ended. So this period here kind of marked the line where we said, okay, if something's going to happen, this will be the line in the sand, because we had gone through all of the different problems in terms of breaking moving averages and all that during this October, and this V was very quick. Remember that? It just came right back up, and I think the market was a little worried about QE ending, and then the next question was, well, are they going to raise short-term interest rates? And so far they have not. I still do not believe they will do it this year. I may be surprised, but the consensus is still that they're going to raise them at some point here this fall. I don't think they'll do it, and we'll see. But regardless, the market is taking it better than it has in the past. There's no question it struggled. We've kind of been in this little box, for a while now, and that's really what 2015 has been characterized by, is this sideways, choppy, not going anywhere market. And so it's been very frustrating if you're buying or holding a diversified portfolio. There's been some trades to make. We'll get into some things in a little bit that have been working. But for the most part, it's been a very benign year across the board. The international scene has still been working better than the U.S., but even the international has sold off in the last few days. And again, part of this has to do with currencies, part of this has to do with interest rates, part of this has to do with the economy. We're still seeing job growth in the United States. We're still seeing a lot of the economic indicators we look at improving. But there's no question the market over the last few months here has started to deteriorate a bit. And there's nothing really I can show you on the screen, but essentially, if you think about it, a lot of stocks are already in their own bear market. So when you look at that, what does that mean? Well, stocks technically down 20% off their high. A lot of stocks aren't participating in these rallies. So that's the thing that we need to see if that corrects itself. But you are seeing some deterioration. This almost looks like an early 07. And not to say 08's coming, but that's the last thing I can reference is 07, when we saw that type of deterioration that happened for months and months, and eventually the stock market caved in as the big caps joined the medium and small cap companies. But as of right now, we're getting a good rally today based on the fact that why? I don't know. We can say it's this, we can say it's that. Bottom line is we're a little oversold in the short term, but I think, one thing that's interesting is if you go back and look at this trend we've had, and we've drawn this line for a long time, has been here. That little purple line you're looking at, this is the 100-day moving average, and that's really been the line in the sand that, besides October, has been holding up very well and has been the support for the stock market. Well, no surprise, we got down to that, and then we're getting a bounce today as I speak with about an hour and a half to go, and we'll see what happens the rest of the day. But most of the indices are up anywhere from 1.5% or so, percent to 1.5%. So a pretty strong day, not only here, but internationally. Of course, the volatility index is falling down. You're getting oil up about 2.5% today. So oil has been very steady and maybe finding that equilibrium. So we'll touch on that in just a minute. But getting back to the S&P, where do we expect this to go? Is it going to do this? No, I don't think it will. But we've been moving sideways, and really all we're doing is with today's gains is getting back to where the market was 4 days ago. So it's not that big of a deal, but certainly these things can build on themselves. And I would say, looking back over history, the more time you spend moving sideways, usually those things resolve themselves to the upside, it looks like, over the real long term. In other words, even the 87 crash came after a run up. Usually you get these sideways movements, then they run up, and you get that exuberance before something bad happens. We definitely don't have exuberance. Yes, there's some complacency on the part of investors, but I'd say it's still apprehension overall. So that's what the S&P looks like, which is still in this little channel. Nothing happening for most of this year. It's choppy sideways, and we'll see if we get a run. I still do think we have more upside than downside, still more heavily invested in stocks. If we take a look at interest rates, this is what I've been telling you, is that interest rates going up, the stock market's held up very well given this. And somebody asked me today, I thought stocks and bonds moved opposite of each other. That's not always the case. Stocks and bonds over the long term may have a zero correlation, but I think what happens is there's a tipping point. There's going to be a rate when the 10-year gets to a certain point that stocks hate it. And I don't know what that level is, but there's no question stocks have struggled a little bit during this, but not as much as they did back in 2013 when rates rose so much. Remember that, when rates spiked up in the spring of 2013? That was the taper tantrum. Stocks really sold off during that time. They haven't done that yet, but we're getting a big move in interest rates. You can see this long-term downtrend has broken. So, are we at a new level? Perhaps we are at a new level where we're going to stay somewhere. Let's just say maybe we'll be in this box of now, instead of down here where 1.6 to the low 2s is your range. Maybe now we get in this box where 2.5 to 3% on a 10-year treasury is your range. But what that's doing is helping, and this is one of our holdings in our income strategy, is regional banks. Well, banks in general. It's not just regional banks. There's KBE, which is the banking index. KRE is the regional banking ETF. But, you can go down the list. We own some dividend-paying stocks that are in our dividend portfolio. Companies like Wells Fargo, breaking out to new highs. So the banks, remember, as interest rates go up on the long end of the curve, and they stay low on the short end of the curve, their profit margins are increasing. So if you think of that spread between the two rates, 10-year rates and 2-year rates, that spread is going up, and that's helping all the banking stocks. So that's one area that you need to focus on. Again, if you think rates are going to keep going up, that's one way to play it. Of course, you could just be short treasuries, which we are short treasuries in our income strategy. It's been a bad trade longer term, but since February, it's been a great trade. If you look at TBT, which is one of the instruments we use, TBT, has run up 35% from February. So if you gave up on it down here, you've missed out on some money, okay? And some people did. But over the longer term, rates went down further and lower than we thought. And so long term, it's been a bad trade, but in the short term, it's been good. And I think, if you were to look at some of the economic things for the last year, you'd be surprised that rates would have stayed this low. And they have. And that's been, it's the Fed trying to suppress that. But now the economy deserves higher rates. The economy is not as in bad shape as people think it is. And number two, the Fed's still treating the economy as if it's in recession mode, in crisis mode. They're keeping rates as if we're in a crisis, and we're not. So, at some point they're going to do that. But there's no question they're scared to do that. They've acknowledged that they care what the market thinks. It's not just about the economy. And so let's see if wage growth starts to pick up. Will they start to raise rates? I just don't think they're going to do it this year, but we'll see. But long-term rates have definitely gone up. We broke through 2.4, 2.5 today. And, could we make our way on up to 3%? Absolutely. So let's continue to watch that. But if you're owning a bunch of just bond funds, traditional bond funds, those things are probably going down, because this is what TLT, treasuries, have looked like. Treasuries are down about 17% from their high in February. So that's been a painful trade if you were buying it up here. And again, some of these things you got to watch from a trading perspective. You got to watch how far is this away from its 200-day moving average. It was very stretched. So when it got down to here, this may have been a more decent time to buy, and you did get a rally, but now we've had this sharp sell-off. So some of these things are crossing. Of course, you can see this blue line crossing the purple. That is the 50 crossing the 100, kind of a mini cross there. So all these moving averages are starting to roll over. And I've said this on the radio show, I don't know if this is the time that rates are finally going to go back up. We're still in a low interest rate environment, and we will be for a while. But could we have a new level? This is interest rates again. Can we have a new level instead of being in the ones? Could we see something maybe in the 2.5 to 3, maybe even above 3, somewhere in here? Yeah, we could, and that would be more normalized. But don't expect them to go back to 8% or anything like that, because I don't think this economy nor the economy around the world is going to support that. So let's take a look at the oil. This is USO, just so we can see the intraday level. In fact, let me just switch to this is oil as of yesterday, and we'll come back to USO in a minute. This shows you the end of the day yesterday. So you can see oil obviously had this dramatic drop. We talked about in some of our pictures that we thought 42 could be, not 42, we said low 40s, but we thought that could be an area where it started to find a bottom. It did so, it bounced, came back down, ended up, kind of in this low 40s area, started to move sideways. These moving averages starting to turn up. You can see this blue line crossing back above. We had this run. Everybody thought, it's going back to 100. No, just stabilized. And I thought it'd get to about 65 based on some Fibonacci retracement levels, and it has not done that yet. It started to move sideways, but it's held in there. I think a lot of people were calling for this thing to maybe just start to roll back over again. I'm going to switch to USO so we can see today's action. This adds another 2.5% on here, so you can see that little jump. I'm zooming in. So again, if we break out here, next level, you'd have to see this thing maybe pop up another 10% or so, which would put us at that high 60s level. Once you get a 7 in front of oil, I think you start to get some people feeling a little more confident. I think right now there's people that can make money in oil, but they're still, I think it's a very fragile. It's like walking a tightrope at the 60s because the 40s aren't that far away. But if we get in the 70s, I think people can get profitable again, and you'll start to see some activity that will, benefit that whole sector. So that's oil. If we take a look at the volatility index, we were starting to ramp the last few days. It doesn't look like it on here, but some of the measures I see were starting to turn up for the first time in a while, where we started to get some fear, and that's reversed. Volatility as we speak is down about 9% today. So still scraping the bottom of the barrel on volatility. International, let's take a look at EFA. We don't look at international that often, but breaking out here, got a little pullback, but EFA is doing very well because, look, frankly, Europe's doing much better, and they're in the middle of quantitative easing. So they're kind of where we were a few years ago, where things are improving and they're stimulating. The U.S. is improving, but we're threatening to take away the punch bowl. So there's two different areas. Emerging markets is another area valuation-wise I really like. Had a nice pullback here. Nice if you're short, bad if you're long. But about a 10%, 9.5%, 10% pullback. But still, I think this thing can go higher. We like the growth rates over there. We like the yields. But this is all about the dollar. And if we switch over to that real quick, you can see the dollar. What does this picture tell you? Does it tell you it's going higher or lower? Right. Half of you probably said higher, half of you said lower, which means it's hard for us to do anything with it. So we had this huge move, and looked like, it's definitely rolling over, and then had to spike up. One thing that we have owned in our aggressive strategy, we just took profits on it, is this YCS, which is a double short yen ETF. So if you think the yen's going down, the dollar's going to strengthen, then this is the instrument to hold. And we held it through this. We got this pop. We sold out of it, and now it's down a lot the last few days, down about 5% or so. So we're out of it, and this may be something we would want to get back into. Maybe if we get back down to more of this 200-day moving average or the lower end of this band, we would probably look to add it back, because I think longer term the yen does get weaker given their situation versus the dollar. But it got a little overheated, and we made our money and moved on. It wasn't a lot, but we made some money and moved on, and that was in our aggressive strategy. Let's take a look here at the NASDAQ real quick, just kind of jumping around. And you can see NASDAQ's, look, tech is one of those areas right now that we really like, because there's a lot of neat things going on in tech, and especially the semiconductors. We actually just implemented a buy in this today in our aggressive strategy. So we've owned a company, one specific semiconductor, And we made some money on that in our aggressive strategy, took some profits on that. It was more of a trade. And semiconductors, since we did that trade, they've actually pulled back quite a bit. They had like 5 or 6 down days, about 6% down, but we think it's at support now. So this is an area we bought today. Again, this would maybe be a shorter term trade, but we do like semiconductors right now. There's a lot of consolidation. Avago bought Broadcom. You're seeing other consolidation in that area. And so not only is the fundamentals improving in this area, but you're getting some consolidation where maybe old chip makers are getting with these new chip makers that are in the cameras, that are in you name it. And so we think this is an exciting area, and again, it looks like it's at support right now. So we would look for this to make another run. You can see what this does is it makes a run, trickles down, breaks out to another level, trickles down, breaks out. This one was a little quicker, but we still think this thing has legs. So we like the semiconductor industry. Now, you can go buy the individual stocks. You can go buy the ETF. There's another ETF, XSD is another one. Looks a little different picture because it's more of an equal weight portfolio, whereas SMH has some big, heavy holdings. In fact, Intel's one of its biggest holdings in here, so it's weighted a little differently. All right, last one here, gold. Here's gold, and not much to say there because gold's just messy. We don't own it, and it's just sloppy. I don't know how you really trade this right now. You know, if you're buying it because you think something's bad going to come down soon, and you want to keep some in your portfolio, I have no problem with that. I don't know how to trade this right now until something changes. I think once it broke down to this level, it kind of made it a little more difficult. So don't have a position in gold. Let's see. That is about it. As we sign off here, the Dow Jones up about 260 points. The NASDAQ up about 66. The S&P up about 27. We'll see if this thing gets stronger as the day goes on or if it fades into the close. But continue to watch. And if you have any questions, Karl, Karl, at eggerscapital.com. And don't forget to tune into the radio show and go to the website. You can see all of it on the screen right there. All right. Have a wonderful afternoon. Take care, guys.